So what in the world is the Federal Reserve doing right now? Seriously, it's one of the biggest puzzles in finance. On one hand, they're telling us we are waging an all-out war on inflation. But on the other hand, well, their actions seem to be telling a completely different story.
And that brings us to the big question we're going to tackle in this explainer. Is the Fed secretly hitting the gas on the economy even while they're screaming that they're slamming on the brakes? So who do you believe? What they say or what they do? Let's dive in and figure this out.
Okay, so right here you can see this contradiction in black and white. It's pretty stark. Their words are all about fighting inflation, right? But their actions, injecting $440 billion of liquidity in a single week, that's not just a drop in the bucket. That reversed more than half a year of their so-called tightening. This isn't some minor detail we're talking about. It's a massive U-turn that just begs the question, what is going on?
All right, to really solve this puzzle, we've got to understand the tools in the Fed's toolkit. Think about it like this. After 2020, the Fed basically opened up a fire hose of money to stimulate the economy. Now, they're supposedly trying to turn that hose off and clean up the mess with something we can call the inflation hammer.
So, that fire hose of money? That's called quantitative easing, or QE for short. This is their go-to stimulus tool. In a nutshell, the Fed just creates new money out of thin air on a computer. And then they use that digital cash to buy up government bonds. This floods the financial system with money, makes it cheaper to borrow for things like mortgages and car loans, and gets everyone spending. It's designed to heat up the economy.
And when I say they opened the fire hose, I am not kidding. The scale of QE after the pandemic was just mind-boggling. Look at this. In just 2 years, the Fed's balance sheet, which is basically how many of those bonds it's holding, more than doubled. It jumped from $4 trillion to $9 trillion. That's a $5 trillion increase. That is just an unprecedented amount of new money poured straight into the economy. Wow.
Okay, so what about the other side of the coin? That's quantitative tightening, or QT. This is the inflation hammer we were talking about. It's literally the reverse of QE. Instead of buying more bonds, the Fed just lets the ones it owns expire. They mature, the Treasury pays the Fed back, and then poof, that money essentially disappears from the financial system. The goal is to suck money out of the economy and cool things down.
So the plan seems simple, right? Fight the inflation that QE created by swinging the QT hammer. But here comes the plot twist. What happens when that big old hammer accidentally smacks a really fragile part of the financial system? Well, something breaks.
And that's exactly what happened in March of 2023. The Fed's aggressive rate hikes, a key part of their tightening plan, caused a major crisis. See, all those super safe, long-term government bonds that banks were holding, well, as interest rates shot up, the value of those bonds plummeted. We're talking by about 30%. So naturally, when people with money at banks like Silicon Valley Bank caught wind of this, they panicked. And they did what anyone would do. They tried to pull their money out all at once. That's a classic bank run, and it led to the bank's collapse.
And this wasn't just a small scare. The panic was very, very real. Get this. In a single week, depositors yanked $550 billion out of U.S. banks. So the Fed's policy, which was designed to solve the inflation problem, had just created a brand new and frankly much scarier problem, the risk of the entire banking system going down.
Okay, so the system is on the brink of collapse. The Fed has to do something, and they have to do it fast. And this, right here, is where all the confusion really begins. They rolled out this emergency program to stop the bleeding, a program they were very, very careful to call not QE.
So what was this Bank Term Funding Program, or BTFP? Well, how it worked is absolutely crucial to understanding this whole mess. Basically, the Fed let these struggling banks come to them and trade in their devalued bonds for cash loans. But, and this is the kicker, this is the most important part, the Fed didn't value those bonds at their new, crashed market price. No, they accepted them at their original, full face value. It was like pretending the losses never happened. And the effect? It was immediate, and it was absolutely gigantic. In just 1 week, the Fed injected $440 billion back into the banking system. Think about that. With one move, they wiped out a huge chunk of all the tightening they'd painfully done over the past year and a half. Just gone. So the big question is, was this just QE by another name? Was it a bait and switch? Well, if you want to get technical about it, the Fed has a point. See, real QE is when the Fed buys assets permanently, with the broad goal of stimulating the entire economy. The BTFP, on the other hand, was all about temporary loans secured by collateral with a very narrow goal: stop the financial system from imploding. So yeah, different tools, different stated goals, but you know what? To the market, money is money, cash is cash, and this was a giant injection of it.
And this whole episode, the crisis and the response, backed the Fed into a corner. It put them in an impossible situation, the classic central banker's dilemma. They were well and truly stuck between a rock and a hard place.
This quote from Real Investment Advice just sums up the problem perfectly. It says if they focus on inflation and continue hiking rates, the risk of a further crack in financial stability increases. But if they focus on financial stability, they risk creating another inflationary and interest rate spike. That's it right there. Damned if you do, damned if you don't.
This is the heart of the conflict, you see. The Fed really has two main jobs, and right now, those two jobs are fighting each other. Job one is price stability. Keep inflation under control. That's the rock. Job two is financial stability. Prevent the entire financial system from collapsing. That's the hard place. And in March of 2023, when push came to shove, they had to choose. And they chose financial stability. They had to save the system. Now, to really get why this is such a pickle, we need to zoom out for a second. Let's not just look at the Fed, but at the government's balance sheet as a whole. That means the Fed and the Treasury together. You can think of a program like QE as basically a giant swap. The government takes long-term debt, think 10-year bonds, out of the hands of the public, and in its place it gives them short-term, cash-like stuff like bank reserves. And here's the key takeaway from that swap. It's a transfer of risk. By doing this, the government itself is the one holding the bag. It takes on the risk that interest rates might go up and make all those long-term bonds worth less. And that really helps explain why the Fed is so jumpy about financial stability. They're trying to manage a massive risk that is ultimately sitting on their own books.
Okay, so they're stuck in this crazy dilemma. So what's the path forward? What is the Fed doing right now to walk this tightrope? Well, the clues are in their most recent moves.
So flash forward to May of 2024. We saw the Fed take a very, very cautious step back from the ledge. They came out and basically acknowledged, there are risks to the system. And so they announced they were going to slow down the pace of QT. Instead of letting $35 billion in bonds roll off the books each month, they're now only doing $25 billion.
And that brings us right back to where we started. The big question. Is this the pivot? Is slowing down the tightening just another way of saying they're starting to ease? Are they subtly putting a toe back on the gas pedal?
Now, if you ask the Fed, they'll say, absolutely not. We're still tightening. We're just doing it a little more slowly. But the market? Yeah, the market isn't buying that for a second. The moment that news hit, what happened? Stocks, gold, silver, they all rallied. Why? Because investors have a very simple motto. Less tightening is a form of easing. For them, taking your foot off the brake, even a little bit, is the very first step before you slam on the accelerator.
And this really gets us to the heart of the matter. The Fed's balancing act is just incredibly, incredibly delicate. You see, to stop another crisis like what we saw in 2023, they have to make sure there's always enough cash in the banking system. They call this having ample reserves. The system needs that liquidity to stay stable. And that fundamental need for stability puts a hard ceiling on how much they can ever really tighten. There's a limit.
And all of this leads to one final, huge question. In our modern economy, an economy that has been fed a diet of low interest rates and easy money for decades, can a central bank truly fight inflation without something, somewhere, inevitably breaking? Can they swing the hammer without shattering the glass? And that is the central banker's dilemma.